So hello everyone, and this is tutorial 5, and I'm recording. This is bank capital planning. We have few questions and few concepts, and we will go over those few concepts and a few questions. There are some technical issues, and I want you to be aware of it. If you can stop me during the or ask me during the process while I'm proceeding in this tutorial, it will also be good. If you have a problem with my, if you cannot hear me or something, just also please let me know. Okay, so today we are talking about this, which we call a bank capital planning. And this is actually tutorial number 4, tutorial number 5. Now, most the concepts which we have to understand in this tutorial is the following. So we want first to understand the definition of capital. If we understand that, because this time we are talking about definition and we are talking about functionality and also definition. The definition of capital and incorporates is just equity, and the function of capital when we have a business company is what we call to buy assets. Here the case is different. We have tier 1 and tier 2, and we have total capital, and we have equity capital, you know, so many definitions. We will just try to know it briefly, because we will talk about it in details when we go to week 11. Now, so the second thing, after we know the definition of capital, we want to go to the core of this week discussions and topic and lecture, which is actually we want to talk about the target capital. Now, when we talk about the target capital, we want to know how much is that capital. And then when we know how much that capital, then we can, if we satisfy that issue and we know how much we have capital, then in this case, we can continue in our growth. We are safe in that area. It's just now, how can we maintain this target capital for the future and for a long time? Now, to maintain it, we have 2 models. So actually, to manage it now, we have what we call the achieving and maintaining target capital while growing. So we have 2 models. One model, and the technicality is here. Actually, the technical issues is here. One model called the ICGR, or internal capital generation rate. And we have another one called the asset growth model. Now, both of them are helping me to keep my capital, to keep my target capital while I'm growing. This is the whole purpose of it. Now, so this one, for example, will tell me if you have this capital in time zero over your assets in time zero, this should be the percentage of your capital in time zero. Now you are growing and your capital is increasing. So to keep this target capital all the time constant, any growth in your capital, which is 1 times the growth or plus the growth, you can go ahead and increase it with the same growth percentage. You can go now and increase the asset with the same asset in time zero. You can increase it by the same growth. End of the day, you will have the same percentage all the time, which means now this percentage is actually the same. And this is the target capital. So if I am setting my target capital and I want to keep it all the time, this is the right way and it's a passive way. Whatever when we talk to me about growth and the ICGR is whatever you grow in your capital, grow in your asset. So you keep this intact. Somebody will tell me, is the capital going to asset to finance these assets? No, it's the requirement. The requirement is telling me that I have a percentage of, I should have, for example, a target capital of say 10% all the time. If you have the capital over the asset, should be 10%. And now, where is the 90%? The 90% you can get it from liabilities to finance a loan. But you cannot, under any circumstances, come and say, okay, I will finance this by 5% and bring this 95%. I can bring the 95%. The problem is here, I will have a problem because now the capital, the target capital should be enough to buffer the losses, if there is any losses. And I already decided and when I started to determine my target capital to be 10%. Anything less than that, it's a problem. This model will tell me, keep this 10% all the time. You want to grow? Fine. When this 10% grows 10% more, go and let your assets grow 10% more. And we continue like this. This is the whole story. Now, the AGM is different. AGM is telling me, I don't want to be passive and I don't want to wait for the internal capital to determine my growth. I have to set, I want to acquire, I want to penetrate new market. Maybe if this is 7%, maybe my desire, if the growth, which is this G, is 5%, 7%, no, my plan is to have 10% or 20% growth. And therefore, if I want to increase my asset by 20%, while this is only increasing the internal capital from the normal operation is increasing by 5%, then this percentage will not work. This percentage will be distorted. And therefore, we have to ask for external capital. So again, this is based on internal capital, which means the return earning. This is based on both internal plus external capital, which means I can get whatever I like, whatever I can get from my internal, but my growth is high, I will go and look for external capital, which means make new issues, issue new shares or preference shares or do hybrid, issue hybrid securities, whatever, to increase this. Having said that, I think we should be okay. We should be okay because if I have less capital, I can take it from external capital. If I have less capital, for example, if the growth now is just the opposite, 20%. See, this is 2019. And then we come to 2020 when the COVID comes and they can only grow 5%. People will take loans only up to 5% more, which means now I have a surplus of capital. This surplus of capital means, which means if you take now, if you calculate the target capital in time 1 will be higher than the target capital in time 0, because this one has increased and they can increase only this by 5%. So in this case, I am what we call it overcapitalized. If I am overcapitalized, I can either pay the rest, the 15%, the difference 15%, which is because they grow, because I need only to keep my target capital, I need only 5%. So now, if I have 15% more. That 15%, I can make it, I can go and pay back some of my shares, I can go and do anything else. I can go and pay more dividends, or I can say, well, can I go ahead a little bit and increase this to make it 10% so I can consume more of the capital? This is the 3 things I can do. This is the whole story. Now, let me go back to my question. This is the whole story, a whole story behind this tutorial. If you understand it like this, it will be a piece of cake, because maybe in the test, I will play with some of those ideas. Now, question number 1, explain how bank capital is different from capital in manufacturing company. What is the difference between tier 1 and tier 2 capital? It is different because capital and banks is mainly needed to, 1, source of long-term financing, which is actually not the big thing. The big thing is here. The big thing is here, which is buffer against expected losses. But it can be part of my long-term funding. I have loans or investment of 20, 30 years. I don't need this capital and nobody will asking it because it's the shareholders' money. I can participate in that one. Most importantly also, I can operate with the capital. This banking issue operate within this trust economy. And this trust economy, when we trust the banks with our money, we need to see some type of signs that show us that we should trust them. And capital is one of the things. So it shows that first commitment. So when the capital, for example, 10.5%, it is telling me as a depositor that in each dollar of loan, if this is a dollar of loan, $1 loan, 10% will be paid by the customers, financed by the owners of the bank, which is the shareholders, and 89.5% from me. Well, this is still even much. Yes, I know. But if there is a problem in the loan of the $1 or losses, we are not going to divide it. I will take all of this. I will consume all of this first, then I will go to you. Which means now, if only 95%, if only 95 cents paid from me, from the loan, you will not be charged because I will take the 5% decrease from here. This is what we mean, the commitment. So depositors need to see this capital higher, and also creditors. So it shows commitment. The other thing, it supports market confidence because banks are strong and good capitalized. So actually, and when they are less capitalized, there will be a market discipline, and the market discipline, which means they can be penalized. So capital is there to also discipline the management. If they are doing well, we will give them, we will ask for less, you know, cost of fund, and we will not penalize them. We will not, you know, ask for higher return and increase the risk. So in this case, capital is also a sign, or whether the bank is strong or not strong, and whether we should perceive that as risky or not risky, and whether we should, you know, increase our expected rate of return from this bank or no. It depends on the capital. So it's actually, it supports the confidence in the bank, which means higher capital actually supporting the confidence. This idea, I want you to be aware of it, but we are talking about actually as a buffer. Now, why capital companies needed? To finance asset. If you bring any company now, they want to finance their machines, buildings, you know, supplies, all these things, which is another issue. But for us, the capital, the liabilities will finance our asset. We'll pay loans and all these things. The capital will only be a buffer there and bring confidence, whatever. See the difference now. It's a different concept. Now, when we come to the capital, I want to show you this, and I will show you this in week 12. This is just for explanation. Don't worry about it. Capital is like this pyramid. Now, this one is actually the equity, which we know it incorporates. Now, the equity is part of another structure called tier 1. So tier 1 is equity and other tier 1. Like preference shares, like hybrid securities, like provision for losses, the ones we explained clearly in the lecture. Now, after that, we will go to an area, which is this area, which called tier 2. Now, tier 2 is also for example, here, cumulative, non-cumulative preference shares, here, cumulative preference shares. If you look at the items of tier 2, it's here, which is different from this. So this one all called, and I want you to look at it, there are 5 items. This is tier 2. And this one called total capital. Now in corporates, we have only this one. Here, see the thing? We have so many things coming in this pyramid. And therefore, here we say what is tier 1. Tier 1 is actually this area, which is actually focused, it's a good quality. Why do you mean by good quality? If there is a problem, I can access it without any restrictions. Equity is almost like a cash inside the company. I go and, so it's the capital there. But when you say, you know, revaluation reserves is, my building was 105 million, now it is 50 million, which means if I want to take this capital, I have to sell the building. I have to sell the assets. It's another issue, okay? So tier 1 actually, which is this area, focus in capital planning. And it has greater risk reduction per dollar because this is, you can access it with all the capital here is easy access. And it's long lead time and more expense involved in raising tier 1. So they still stay here like equity for longer time. Tier 2 can be some type of debt that can be changed to equities, or some types of provisions that can be used. So they are not long time, but equity will still equity. As long as you are shareholder, it will be forever. Yes, the owners will change. They can sell their shares from 1 to 1, but the shareholders with the equity will still equity, regardless who will own it until the. So it's a longer lead time. So this is when we talk about tier one. Now tier two is just a supplementary capital. It's less accessible capital to buffer risks and therefore less risk reduction. So tier two is actually, I told you, either professions, we can use them, or either reevaluation assets, or either non-cumulative, cumulative preference shares, which means, yes, they are equities, but they are preference shares, but they are like a debt. We have to pay them every year. And if we don't pay them this year, we pay next year. This is what when we talked about cumulative preference shares. Anyways, the take home from here is tier one is very access, and regulators like it, and also depositors, investor depositors like it, because it's very easy, and the big part of it is this one, the equity. This is one another capital it's called supplementary, and I think the regulators come with this definition to make banks operate. Instead of telling them your capital is only the equity, they bring so other things so they can satisfy that 10% whatever. Okay, we are done with this question now, which means this issue now we finish it. Any question? Can I proceed? Any question?
No, sir. Oh, good.
Thank you very much. Okay, we go now to the target capital, which is the most and the core issue in this tutorial and in this class. Look, my friends, this is and I explained this so many times, but this is specifically, this graph was designed specifically for the capital. So this is the debt, which means how much capital. The question now, the big question, how much capital I should have, or what is my target capital, which means how much capital I should have, what is the percentage, what is the optimal percentage from private incentive, which means not the regulators tell me keep 10.5%. My bank, as my specific bank, with its risk, with its operation located in Japan or Malaysia or in Korea, how much capital actually I need, regardless what the regulators will say, for everyone in the world, 10.5. I'm talking about myself, how much I should have. Now, I have to, because the assets, these dollar assets, is actually coming from capital, as I told you, or debt. This combination, I want to know it. And I want this combination that will increase my value of the bank. I don't care. Don't tell me this, less capital is higher, high capital is better, and less capital is. No, I have to do simulations and test my profit and my earnings that increase the value of the bank under so many scenarios and many simulations until I reach to the best point. Somebody will tell you, okay, when you take debt, it costs you 6%. Not only that, and if you are under the tax of 35%, which means you are going to pay less tax, which means this will be an expense. You pay 6%, so 6% times 35. This is actually what you will pay, which will come around, I don't know, 35. You are going to pay around 3 something. I can tell you now how much actually you will pay at the end. $3.9. See how cheap you are? Actually, this is actual cost. But when you take equity, they ask for 20% cut, and there is no tax exemption. Why there is no tax exemption? Because it's distribution for the net income, not an expense on the income. This is an expense on the income because you take it from someone and there is a servicing interest for that. This is the shareholders' money. They just wait for the net income and to give them dividends. So you don't say, oh, this is, I will give it to the shareholders. It's a charge to the income. No, it is coming, it is just the net income. So there is no tax benefit here. Therefore, if I take these things, maybe better for me to take debt. If this is the debt line, which means I will go from 0 in my assets to 100%. So I will go, then I will take this line. I will take this blue line. Continue, because my value here, when a debt is 0, this is the value of the company. When I take more debt, my value of company goes up, continue. But the problem is, if nobody is annoying me or rejecting this behavior, then I will just continue. Maybe I will reach to 100% of every loan I take just from outside. But the problem is the compliance. The regulators will come and will tell me, no, you cannot do that. And they will start to punish me. Fine, banish me. As long as they banish me, and the banishment, the cost of the banishment is less than the earnings, I'm going okay. I'm going okay, which means what we call about the marginal cost still, which is here the marginal income minus the marginal cost, still plus. I'm continuing this area. I will continue. I will just continue here. Until this point, I'm here. I'm here. Marginal cost is higher. I still take until I reach to this point. This point, it becomes 0, which means no way you can take more. Marginal cost, your marginal cost equal your marginal income. If you go here, you're still taking more debt, then actually the benefit, this become minus. And then actually you are going down, no need. I want this point, I want to stop here. So if I want to stop here, this is my target capital, and this is how we do our target capital. How we do it, we have to collect data, we have to do simulations, we have to test this issue, which is the trade-off. This, we call it the trade-off between marginal income and marginal cost. So let me just take you here. This was an exam question. I want to ask the class, if this is the debt, and this is the value of the firm, where should I stop? Anyone? A, B, or C, or D?
C.
Okay, I agree with you. Now, if I convert this to numbers, and this C is becoming 85%, and this B is 50%, and I can reach, and I tell you this area is 85%. So how much capital now I should have? What is my target capital? You are now in position to tell me what is my target capital.
The C, 85%?
No, my debt is 85%. My assets, this is very technical issue, which I want you to understand it. My asset is $1, right? This $1 coming 85% from debt. So how much, and it is optimal. How much my capital?
15%.
15. 85 plus equals 100%, right? If the debt, this is, if I am financing my assets either by debt or capital, but both of them should be 100%, right? Now, if I tell you I am giving you the loan for 85, I mean the debt, I should have the optimal debt 85, means the optimal capital is what? 15, right?
15. Yes.
Yeah, so this is what we call target, our target capital. So if I give you these graphs, anywhere you see them, you can know already. I need only to know this. So this is the whole thing, how the target capital work. How do you reach to this point? I told you it's too much numbering. You are not responsible about this in this stage. Maybe when you become, a financial analyst, whatever, but this is the whole concept. Okay. If we are done with this, we come to the point of the trade-off. So the trade-off, this is the concept of the trade-off. So you increase, you see, you increase the assets, the debt, and reduce the capital, as long as the marginal increase in shareholders' wealth due to the taxation outweighs, this is the right word, outweighs the marginal decrease in shareholders' wealth, as exactly as I explained. When it is outweighs, you just continue, because that means we are in this area, in the plus area. Here we are outweighting on marginal income higher than the marginal cost, which means I am here. Continue, no problem. Until you reach here, stop. So this is I want you to know, to understand. I will upload for you the tutorial, but I want you to understand this concept of the trade-off. This concept of the very important, okay? And it comes with what we call this concept of trade-off, okay? Now, let me go now to third question. Now, the third question is saying what? I'm done with this. Now we go just to the calculation. So this is the calculation. As I told you in the calculation, we have two types of, and I want you to understand it very well. Now, I will ask you a question, and it is a very technical question. According to these numbers, what is my target capital? Ryan?
So is it the capital at start of year times 7%?
Yeah, it's already mentioned here. The target capital ratio is 7%. Okay? Do you agree?
Yes, sir.
Everyone? Yeah, okay. Now coming back what we just told me. If it is 7% the target capital, which I already decided early, do you think this bank is in target or not in target? Because the capital should be this one divided by this one. 3780. This is a beginning of the year. 3780 over 54,100. Right? If you calculate this one, it's actually 6.996, which means 7%. Which means actually I am in target. I set my target and I am fine. Now this model is telling you whatever you get, whatever increase happens and your capital through the retained earning, go and increase your assets the same. In other words, if I have like now 378 over 54,100 beginning of the year, which is 7%. Now, the year 2, you should have the same target. Just give me the capital, which is this one, times its growth, times its growth, which means plus the capital with its target next year, or the asset times plus its target, its growth next year. And you will continue with the 7%. So in this case, because our main concern is to keep the target constant, because we don't want to go over the target or under the target. This is the purpose. So this model is telling me what? This is the model, and I will tell you, ICGR is telling me, this is the formula. The calculation is easy. The translation is actually 1 over the capital ratio, beginning of the year, times what that capital, the earning during the year of that over the capital, minus what did you pay from that earning as tax. So according to this, the capital was 14 times this. Actually, this is the assets comparing to the capital. Let me just use my calculator. 14 this is 1428 times ROA is how much? 1.2%, okay? Times 55%, 1 minus 55%, which is 45%. If I calculate this, this is 7.7%. What does it mean? It means my capital has grown by 7.7%, which means my capital, which is the 3,780 now, has increased by this is the capital now, this is the growth, right? And so if your capital has increased by this number, you are allowed to increase your asset maximum of 7.7%. And why I should do that? Because you will have 7%, same, which is you are keeping the target. So the bottom line is of this model, ICGR, increase your capital with the same percentage increase, increase your assets, because we want to increase our asset and growth with the same percentage increase of your capital. Why? To keep your target constant. That's it. This is for this model. Now, is there any question or can I continue?
Oh, good, sir.
Okay, thank you. Let's go to the next model. The next model is what we call the asset growth model. Asset growth model is different. They want us, this percentage is not the same thing. These people want some growth, and they want here 15%. The question is the 15% enough? Is the 15% enough? Is the internal capital enough? I have only how much here? 7.7%. Actually not enough, which means the difference, I have to look at it. That will reflect itself on the percentage. If I go ahead and I say, okay, I don't care, I want to penetrate the market and I want to increase my assets by 15%. This is the asset growth. So they give us this, what you call projected capital ratio. You can call it projected capital ratio, or you can call it capital ratio in year one, whatever you like. And it is actually the capital of the year, beginning of the year, over the asset over the beginning of the year. I just want to know what is the growth of the, so I will have to get the growth of the assets times the asset in the beginning of the year, times its growth, times how much it earns, ROA, times minus how much I pay as dividends. And this is times its growth. Now somebody will tell me, what do you mean by this? Look, I will tell you. This is the capital beginning of the year, which we have it, right? I want to see the increase in this capital. The increase in this capital is actually the profit of my assets minus the dividends. So actually this is, which is the retained earning. So I have the net income minus the dividends. It becomes the retained earning. This is actually the retained earning. Let's see. This is 3780 plus how much my net income? My net income is this one. The assets times its growth, the asset and its growth in the same year, which is, this is 54,100 times its growth, which is 115. And this, all of this will earn 1.2%. I can make it like this. And it will pay 1 minus 45%. 1 minus 55%, which means now over what? Over my assets, which is 54,100 times its growth. So this is actually the asset in year two. And this is in year zero. This is year zero, and this is year one. This is asset in year one, and this is the asset in year zero. So all of this is the asset plus its growth is year one. So all I have to do now is to find this to be, if you calculate it, it's my capital now, instead of 3,180, it becomes 4,116, and this becomes 62,215. And this is telling me, if you continue with your growth, you will have 6.62%. This is different from the AGM, from the ICGR, because this one is telling me your capital now, your target ratio now is 6.62. So my question to you guys, am I undercapitalized? Am I under the target, over the target, or exactly like the target? How much my target was? This is telling me,
7%.
yes. So am I now under the target after I decided to go capital growth or 15%? Am I now
Yes.
under or after or over?
Under.
Yes, you are under the target. So if I'm under the target, what I should do? According to the theory, I should go and raise capital. Because the internal capital already consumed in the growth of the assets and give me, with all this, it can give me only 6.62. So actually I need to go for external capital. The question is how much? So I have to go back at least for the 7%. I have to go for the 7%. So I have to go for external capital. Now, if I go for external capital, I want to know how much. They tell you easy, calculate it like this. This is the formula. Projected ratio, the one I calculated. Target ratio was 7%. Times the assets, which is 54,100, in time zero. Assets in time zero, CA0. Times its growth, which is 1 plus 15. Now I can calculate. Oh, this is when we have 8%. Oh, it's here. Sorry. This is when it was 8% target. This is here 6.62 minus 7% times 54,100 times 1 times 15, and it shows that I need this amount. So the calculation show me I need to raise 236,000,042. Where I should raise it? I should raise it from the following places. I can go and issue, at least until now, are we okay? Because the AGM now, the process like this, the AGM will start with the growth, which means it may distort my target capital. If it distorts my target capital and my target capital increase, I have to go and calculate what we call the deficit in my capital, which is I calculated here to be 236. I go and raise it from these areas. This is now theory. I can go issue. This is actually the equity, actually, or tier one. This is tier one capital. I go and increase tier one capital. Now, this is one case. The case number two, Ryan, what if this is not 6.62? What if this is 8%? Am I overcapitalized, undercapitalized, or actually the same?
Over, sir.
Yeah, which means I have now, what should I do? I should get rid of some of this capital. So I go, if I want to get rid of this capital, look, I want to go for the calculation because the question here said the same thing. The question said, what do you suggest if Bank ABC projected sample capital ratio is 8%, which is higher than the my target capital of 7%. I will see how much is that. I go and make this 8%, and I make this 7%. Same thing for 54,100 times 1.15, and find this to be 622 million. So I have now 622 million surplus. The theory, and according to the lecture, give me the following chances. You can go and increase your, pay more dividends. You have more money, go pay more dividends. From the return earning, decrease the return earning. So you can pay it, and you can pay 622 to come to the 7%. Or go and pay back some of your shares. Or go and increase your asset growth. Instead of 15%, maybe you work with it and you make it 20%. You can solve for how much the asset growth should be in this formula, how much the asset growth should be to have a 7%, to have a 7%. For example, here, I will not ask you this question in the exam, whatever, but I can solve for it. I can, in this formula, the asset growth, I can make it X, and I make this 7%, and I solve for this one. And I can tell you how much growth with this increase can, I can have the 7%. This is one of the things. So I can decrease my, my asset, my growth. So one of the things is increase my growth. So it eats the extra capital. It eats the extra capital. I can do all these things. Or I can review my calculation. Maybe my calculation need to be more conservative or whatever, and the formula will show me some other things. But mainly you have to look at these ones. Okay, if we are done with this, we are done actually with the technical thing, all the technical thing in this tutorial. Let me now go to, this is just a question, which is following here when we do the calculation. Explain the meaning of the two numbers calculated in question A and question B, which means explain what does 7.7% mean for the ICGR, and explain here what the 7. What does the 6.62 means for the AGM. The answer is, for the internal capital, the bank relying on internally generated capital is able to expand its asset by 7.7% while maintaining its capital ratio, which we talked about it. What about the asset growth model? The bank will have a capital ratio of 6.62% if it goes ahead with its planned asset, but relies only on return earning. If you continue and depends on, then your target capital will drop to 6.62%. That's the whole thing. Can I continue from here? Any questions?
No, sir.
Okay, thank you. Okay, there is one only question, additional question, which is the setting target capital ratio. We said, what does debt capacity means when we decide in capital and the target capital. So debt capacity and flexibility, a bank may wish to hold more equity capital so that they, which means if my loan asset structure now is financed 85% debt, which is depositors' money, 15% capital. This is the loans. And there is another scenario where I have 90% debt and 2% capital. So this is also 100%. This is 100%. Here I have more debt capacity. Because if I need to increase, I can go and increase. If something happens, I still can increase my debt to 90% and the asset 10%. Still I can survive. But here with 2%, it's only 2%. If there is a problem and I need 3%, 4%, I cannot do it anymore. Finish. My debt is already done. I cannot leverage anymore. It's everything is already in debt. Okay. So you need some capacity now. When you have more capital, you still can play with the. The other thing is of course, in this case, for example, people will perceive you more, but this is already very, very risky. Very, very risky. If you are going to reach 100% of your assets from debt, then it's a problem. And if you go over that and become 105, it's already something wrong. It's already something wrong, which means the money, I don't know, 5%, nobody knows where is it. Anyway, just let's say, to make it brief, when we have 10%, when we have higher capital, we still have room to maneuver and to take debt in the future. Here, we execute every possibility to get more debt. Now, the other thing is corporate control, and we talked about corporate control when the debitors, creditors, plus management increase their holdings in the company. So say maybe they become 97% and equity becomes 3%. This is already minority. So this is one of the calls to increase the debt and not the capital. This is increased debt. But anyways, whether you are talking about this or this, according to the recent regulations, you have to keep 10% capital, according to Basel. 10% total capital, which I told you, if you look at this, the pyramid, you have to have here total capital of 10%. This is what the current regulations say. Total capital should be 2.5%, and part of it tier 1, part of it equity. So the equity should be 7%. Tier 1 with the equity should be 8.5%. And tier 2, of course, the rest. So the regulations tell you this 7%, this is 8.5%, and all of them should be 10.5%. So this is the, so in this case, you cannot maneuver, actually, you cannot come to 97%. You can maneuver after the 89. So all the time, you have to have 10.5 and 89.5 debt. So this is the limitation where you can work. You can make it 80 to 85, you can go to 70. So capital should be at least 10.5%. And this is actually decrease the room for leveraging. You can leverage after that, or you can decrease or increase the debt within that limit, which means you can increase your capital to 20%, 30%, but you cannot decrease it under 10.5%. This is just to tell you that when we look at this, it's not obsolete. It's not obsolete. We have to have some consideration like this. So this is actually 8.5%. Equity capital 7%. So very. Now we are actually done. There is nothing here, but this is coming to the theory of signaling theory. Now in signaling theory, if you look, I take two banks, Maybank and Public Bank, Malaysia, 2018, and I look to their reports. All of them are saying, because if we say, for example, capital, the income, if we say the income is actually return earning or dividends, but they cannot be both. Signaling theory is saying you can increase dividends and increase the growth. And this is signaling theory. So all of those banks are working in signaling theory. Look, bank saying we have increased our asset from 560 billion in 2013 to 806 in 2018. But in the same time, we sustain our shareholders' rewards and we pay dividends of 70%, which is very high, which means we are growing and paying dividends. Public Bank is saying the same thing, that they are growing and making a lot of profits, 7.10 billion in 2018, but still with all this growth and the strength of their balance sheet, they still can pay dividends of 96 cents and actually around 2.68 billion or 47%, which means they are paying dividends of 47%. Return earning is 51.3%. This is Public Bank. Maybank is saying dividends of 70%, return earning of 30%. And all of them say we are growing. All of this called signaling theory to reflect strength. I am done, my friends. Any question?
No, sir. Oh, good.
Okay, then if there is no questions, I will just say thank you. Yeah, I'll just say thank you. And if there is any question, I will record this one. I will upload it. And hopefully if there is any question, just call me. Just send me an email or whatever. We will discuss most of those things in the workshop. Thank you and good day.
Thank you, sir. See
Thank
you.
you. Bye-bye. Thank you.